Welcome everyone to this Blended Finance webinar. My name is David Hetherington. I'm the CEO of Impact Investing Australia, the national peak body for impact investing, and I'll be hosting the first part of the webinar today. I'll introduce my co-host and our panelists in just a moment. Before I begin, I'd like to acknowledge the traditional owners of the lands I'm joining from, the Gadigal people of the Eora Nation, and to acknowledge the traditional owners from all the lands from which you join us. These are peoples who've had custodianship for 60,000 years, and we're very grateful for that custodianship. A couple of house rules that you'll all be pretty familiar with in the context of webinars like these. We're all going to leave our videos on, that is the panelists and the co-hosts. Feel free to have yours on if you'd like to. We will be recording the webinar, so we just want to make you aware of that at the outset. That will be the panel discussion only. We won't record the Q&A part of the event. And questions will be handled in the usual fashion. So please feel free to either put questions in the chat box, and hopefully we'll have a flow of those coming through, or feel free to raise your hand, and Donna, my co-host, will make sure you have a chance to put your question to the group. A little bit of scene setting for why we've chosen to tackle this topic today. This is an ongoing series of webinars co-hosted by Impact Investing Australia and the University of Melbourne, where we're looking at different themes around impact investing. In the last year, we've covered systems lens investing. We've covered barriers for institutional investors. Today, we wanted to take a bit of a deeper dive into blended finance. The kind of formal title of today's webinar is Blended Finance Case Studies from Across the Capital Spectrum. And there's kind of two important, I think, points to take away from that title. One is that here in Australia, I think there's a lot of discussion around the traps on blended finance. Lots of people are thinking about it, talking about it, trying to kind of get to terms with it. But I think there's less activity on the ground in terms of genuine blended finance deals. And so I think there remains a little bit of mystery about what's in a blended finance deal, how you kind of package it together, structure it, execute it. And so we wanted to bring some case studies to a group discussion, and we've deliberately invited panelists who have acquitted blended finance deals and are able to share practical experience in the form of case studies. The other, I think, key point we want to capture in the title is that this is deliberately intended to cover the kind of the spectrum of asset owners, the spectrum of those who provide impact investing capital. So on the one hand, you'll have institutional investors who are, first and foremost, need to deliver market rate risk-adjusted return. On the others, you'll have concessional investors who are able, through mission alignment, to take concessional places in the capital stack. There are organisations who are doing both from balance sheet and via granting, and we'll hear a little bit more about that in a moment. So we're keen to cover both the entirety of the kind of capital spectrum and to focus on real life execution of deals. And hopefully by the end of the hour, you'll feel we've achieved at least part of that. So let me just offer a few brief introductions. Firstly, I'd like to introduce my co-host, Donna Loveridge, who is a research fellow at the University of Melbourne, and Donna has worked with us at IIA to put on these webinars, and we hope that we're building up a stream of content that is valuable to all of you out there in the impact investing ecosystem. And now I'll turn to the three panelists. We're really fortunate today to have people with genuine lived experience of blended finance, who've been thinking about it, working in it, and delivering on it. First, I'll introduce Dr. Catherine Brown, who is an enterprise professor at the University of Melbourne and formerly long-term CEO of the Melbourne Lord Mayor's Charitable Foundation, as many of you will know. Catherine's also a board member with us at Impact Investing Australia and has recently been appointed as a board member of Philanthropy Australia. Next up, I'll introduce Vito Delerba. Vito is a managing director of sustainability investing at Caisse de dépôt et placement du Québec, CDPQ. I hope I've got that reasonably right. So Vito wears a couple of hats, if you like, across the organisation. CDPQ is one of Canada's biggest pension funds. I believe 450 billion plus Canadian dollars in funds under management. And Vito has responsibility both for kind of value creation through innovation across nature, climate, and social within the pension fund, and also direct responsibility for blended finance deal origination. Has worked on a range of deals, as we'll hear, and has much experience to bring to bear. And finally, I'd like to introduce Ben Smith. Ben, as many of you will know, is the head of impact investing here in Australia at the Paul Ramsay Foundation. Has been in that role for probably 3 years now, having come from a leadership role in the UK's impact investing sector. Ben also is an adjunct professor at the Centre for Social Impact at Flinders and chairs the investment committee at National Australia Bank's Impact Investment Fund. Again, Ben has delivered on blended finance deals in his role at PRF, which we will hear about shortly. So hopefully there's a good backdrop for everybody and a sense of who's here in the conversation today. We might now dive into the discussion proper. Catherine, I'll begin with you if I may. You've recently released a paper following an investor roundtable on blended finance that you held earlier this year, where you brought a number of participants together. I guess if we can start broadly, what can you tell us about the state of play of blended finance in Australia at present?
So, David, the roundtable is actually, just to step back a moment, is in a series of roundtables, which we're calling the Blended Finance for Climate Initiative. And that started last year when I joined the Melbourne Business School as an enterprise professor. And it really grew from my passion for, I guess, blended finance from the foundation perspective. And I have one example from that time of my life. But also the concern about how slow our climate transition is and the need to accelerate it, and the fact that one of the things that can help solve our global problem is to move finance faster into to renewable energy and clean tech and so on and so forth. So the roundtable that you just referred to was very much focused on the institutional investor end, the super funds, and had a lens of scaling up. So what I thought I might do, before I could answer your question very briefly, to say I think there's a lot more going on than you might expect. And now that I've gathered quite a few case studies through these 4 roundtables, I'm feeling quite buoyed by what we can achieve, because the key thing to also remember is Australia, while blended finance has been used a lot in developing countries, Australia is a rich country. We've got 4.1, actually I think it's even more now, trillion in our super funds. We've got more than 51 billion in the endowments of foundations and universities and hospitals. You know, we have enormous capability. So it's actually one of the key things I've realised is that one big challenge for us is just to get all the different sources of finance and funding to understand each other and work together more. So I might just show a couple of slides before I just give a few examples. Donna, could I have the first slide? Thanks. I don't know if, has that been shown? Maybe, can we see the slide?
I've got a little note that says Donna Loveridge has started screen sharing, but I don't have.
Okay, well, look, I might just talk about the first slide, and then, because it's,
there you go.
Okay, here we go. So just for people who might be newer to this, the real concept of blended finance, the sort of secret power of it really, is that it combines concessional funding and finance from public and philanthropic funders in a way that can leverage in private capital and institutional capital. So it's impact investment in the sense that people, some of the investors have a particular impact goal in mind, and that could be social, it could be environmental. In this definition from Convergence, which is the peak body based in Canada, it's really talking about achieving the SDGs. The transaction expects to yield a positive financial return, and I'll come to this more in a moment, but the very important point, which you'll see in the next slide, is that all the different investors have different expectations about the returns they might get. So philanthropy won't expect a return, but all the others will expect various returns. The risk appetites they have, the impact lens they might have, and some won't have an impact lens at all, but still be useful in a particular transaction or fund. And also the time horizons they use. So if you're in the super fund, you want long-term time horizon and you want large transactions. So it's about fitting different opportunities to the right funding and finance partners. So the next slide, thank you. I've only got two, so then I can go back to talking. Is the next slide? Yeah. So this is just I found this quite helpful in the different round tables to help people understand the different roles of these sources of finance and funding. So for people who come from philanthropy, we really are in the catalytic capital end, and we don't have a return expectation, but we can carry risk. And we must have, an impact because we have sort of charitable purposes. Then in the government space, there can be grants. There can be development banks like the Asia Development Bank, which manages Australia's climate partnership in our developing partnerships, and then specialist investment vehicles like the CEFC. So they have a lot of opportunities to use different tools, grants, concessional loans, etc., and also technical assistance, which is pretty important because these transactions can be quite complicated. Impact investment is, in a way, I see almost like the glue between everything, can be involved in many different ways. And then private and commercial capital, and then institutional investment when you're really trying to scale up a very large project. And that could be, for example, in wind farms and so on. So I just thought that might be helpful to sort of think about. That's a link down the bottom if these slides get shared to where the reports and the case studies from our roundtables are held, so everyone can have a look at them. But I thought in terms of real world examples, I'd just start with one from my time as CEO of the Lord Mayor's Charitable Foundation, and that one relates to affordable housing. So we decided if we put $1 million of grant on the table, could we attract local government to put in land at no cost or a peppercorn rent for affordable housing? So one of the issues for affordable housing was the location of the housing, that it needed to be well located near public transport, near shops, services, public, green space, etc. And we actually invited proposals from local government, and we had 3 proposals, and we selected one in the city of Darebin in Preston. And then jointly we worked together then to attract a project lead. So Housing Choices Australia was appointed. They're a well-known housing organisation. And then we supported them in getting Housing Victoria funding from the state government. They were also able to get a loan from Treasury, and they're also able to get commercial debt from their bank. So we'd almost had 5 different sources of funding and finance by then. And it basically, this took quite a long time. It sounds straightforward, but it wasn't that straightforward. A lot of processes. But I can say that now there are 39 units in Preston with people living in them, in their energy efficient and their climate safe designs, and they're in the most brilliant spot near shops and libraries. So that's sort of a personal example. So I thought, how can we increase blended finance? And bringing people together seemed to be a good start. So I just wanted to go through a couple of examples that people have presented on at our roundtables. And first of all, I really would like to talk about Grok Ventures. So Grok Ventures is, a private capital source. And the interesting thing about them is their investment in clean tech, that they can take much bigger risks than a lot of other investors because they understand tech backwards. And so one example they gave was of Bright, which is actually Bright with an E, which is a residential solar project, and it has they had seed A and B finance and loans, and then they worked with NAB as well. So there's a quite a combination of state government money, private capital, bank debt, etc. in that one. Then another one would be the Clean Energy Finance Corporation, and I really think Australia should be very relieved that we have the Clean Energy Finance Corporation. They're doing amazing things. Today, you may have even noticed in the paper that they have a new blended finance project with Australian Ethical, which is called Sydney Climate Tech Partners, and that's also for funding emerging early stage decarbonisation technology. So that's a very important platform. But the actual project that they presented was the Golden Plains Wind Farm. And that was a large project which they provided early stage debt, 350 million altogether in 2 stages. And just because they leveraged in institutional investors from around the world. So Westpac, Bank of China, KfW Germany, Commonwealth Bank, and another Danish entity. But there was a power purchasing agreement in place which made that possible. And we also have heard from the Asian Development Bank, and they have an amazing project, a monsoon wind project in Laos. And again, they had a power purchasing agreement in place, and they took like 5 years, I think, that they talked about how long it took them to get it set up. But they basically, it's the biggest, it's 600 megawatts, and it was the biggest renewable energy wind power plant at that in 2023 when it was all finally financed. And it involved as the Asian Development Bank, which is Australia's climate partnership. So we, as you know, taxpayers, are part of that, and also the Government of Canada's Climate Fund and Japan's leading Asia Private Infrastructure Fund. So I mean, I can go on. I actually got a few more in the landscape conservation, but I think I'll stop. But I just think we should really feel very proud of what's happening. But I think what we might come to later is how do we make this move faster?
Well, that's a very heartening place to start, Catherine. Thank you for sharing that. I might come to Vito. Vito, you've been involved for quite some time in a range of blended finance deals across geographies, across asset classes. I'm keen to know from a pension fund perspective, is it better to think of blended finance as a tool or as a product?
I mean, if you read the literature, it comes across as a product. But when you're actually deploying capital, it's a tool. And coming from the asset management business for 20 years, what you realize is that it's a very powerful tool, and one that's, I wouldn't say nascent, but nascent from the perspective of institutional investor adoption is in the early days, because the challenges that we're facing in terms of what we need to solve for as institutional investors are getting more complex. And there's this pool of capital that exists in the world that allows us to go further than we would otherwise go if we didn't have access to it. So there's a mindset shift that we need to think of it as a structuring tool. And the way I've been explaining it over the last few weeks as I've been presenting in different fora is we need to talk about the types of transactions that exist and where blended finance can help. And that's when you start to understand it's not a panacea that's going to solve every world problem, but it can be very surgical and powerful in what it can do. And I divide the world in 3 different segments. The first segment, when we think of a pension plan or an institutional investor, we have specific thematics, and they're different for different institutional investors. Let's say for CDPQ, climate is a very important thematic. There will be transactions in the world in all jurisdictions that will be market clearing transactions with a climate thematic that fits our needs. We will continue to invest in those. We don't need concessional or catalytic capital. We don't need to collaborate with partners that we otherwise wouldn't, because these are par for the course deals that as our assets grow, we will continue to invest. There's the other side of the spectrum, which are deals that have impact, a very, very clean, understandable story, but the risk-adjusted return is not bankable or not attractive, to a point where using catalytic or concessional capital actually it doesn't make sense because the risk is extremely high or the return is significantly too low. That's another space that institutional investors do not invest in. It is a space for governments and capacity building, regulatory environment build out to allow these places to become more investables, or not just places, it could be sectors that are nascent that need new investments. Think new technologies and climate tech and all these types of things, first of a kind and so on and so forth. Then there's the middle, which is high impact, but almost market clearing. There's just a little amount that misses there from a risk perspective or a return perspective, whereby if we were to blend catalytic and commercial capital, we could come to a solution that could meet the hurdles of an institutional investor. And the reasons for this lack of return or increased risk are very market dependent, sector dependent, jurisdiction dependent. So it's very hard to give you a very specific reason as to why they exist, but that's why it's a tool. Because as a structure, when you look at these models, you say, all right, what am I solving for? And that's where blended finance, I think, takes a mindset shift. We want to solve a problem within a structure that otherwise would be investable, and we use different sources of capital to get there. And I want to share one slide because as we'll talk through the different questions later on, I'm always going to refer to a very specific structure. I say that it's hard to generalize, but the reality is there's really only one model that gets used over and over again in different ways. I'm not sure if you can see that. You tell me if you can see that. Can you see that? Yeah, perfect. This model is the archetype of all blended finance models that exist in the world. We use securitization methodology that exists in things like CLOs and mortgage-backed securities and all types of. The actual rating agencies will look at them in the same way that they would look at those types of securities. The only difference is that the commercial capital, which would be your most senior tranche, is usually coming from a commercially driven investor, whereas the subordinated capital is coming from someone like Ben and the philanthropic sector or the public sector that is doesn't have a return requirement that is very defined. They can take significantly more risk, significantly less return, but they are impact and mission oriented. And that is the difference in this model, is that you have different parties that come in with different expected outcomes, all going after a similar goal, which is whatever that thematic is. Climate, in the case of CDPQ, could be affordable housing, as Catherine suggested. And the different types of tools that can be used that you see on this slide are just different types of tools that can be used to reduce the risk or increase the return, either through subordination or implicit leverage and reduce cost of capital. And I'll always come back to this model because you will see that it is basically the archetype of all models. So I'll stop there.
Thank you for that, Vito. Ben, one of the questions Vito posed there is what am I solving for? And I'm conscious that you've spent the last couple of years developing an impact investing strategy for a large philanthropic organization, which has blended finance as an important component. When you're developing a strategy like that, how do you think about the different purposes that can be achieved by different deals? I'm conscious that, not every deal fulfills the same objective within a broader strategy.
Yeah, thanks, David. And it's probably worth just saying a little bit about Paul Ramsay Foundation's adoption of impact investing. And we use something called a total impact approach. And so by that, what it means is that impact investing and the consideration of impact within our finance is kind of inherent within all of the way in which we invest. So that starts with our balance sheet. And so looking at minimum ensuring that we avoid harm through the way in which we invest our endowment, and breaking that down, we kind of divide that up into 90% of that is responsibly invested. So, things like negative screens, introduction of positive screens, etc., etc. But then we also have a 10% allocation of that to a carve out for impact investment funds as well. And so these are funds which are seeking risk adjusted market returns. I think importantly, one of the focus areas that we have there is about supporting emerging funds and emerging fund managers. And so that has very much kind of been a focus area of ours. But then on top of that, then we do have, from the distributions of the endowment, we do have a fund which is established, which is, we call it the Impact First Fund. Effectively, this is looking at strategy aligned opportunities where the strength of the impact for us kind of dictates that we're able and happy to accept concessional financial returns. And I think the reason that it's important to kind of lay that out is that actually we've adopted and used blended finance across the whole spectrum of that capital. And so just to give a couple of examples. So on our Impact First Fund, as I said, the primary concern or the primary objective there is about creating impact. And therefore the blend that we seek to use there is designed to be catalytic, and it's supporting the testing of new approaches. And so there we're happy to accept concessional financial returns. And so actually in those instances, we've operated on both ends of that kind of blended transaction spectrum. So there's a deal that we did called Australian Spatial Analytics, which is a $5 million deal that we did a few years ago now. This is an organization that supports neurodiverse young adults with training and employment to get them into IT and digital profession. And effectively there, what we did was that we decided that, you know, this was a transaction that we really believed in, that we felt there was really strong impact. But when we looked at the organization, effectively what we did was we dissected the business model, and we looked at one element of the business and we thought, well, this absolutely can sustain debt, and this is about growth finance. But then on the other element, there was effectively, it was kind of paying for the impact, and we didn't believe that there was an opportunity for significant financial returns from that element. So actually burdening the organization with debt wasn't anything that it felt it didn't feel appropriate to enable the sustainable growth of that organization. So effectively what we did there was that we split it so that we did a 2.5 mil loan and a 2.5 mil grant. And so in that sense, we were blending ourselves to enable that transaction to go through. Another one as well, so one of the elements that we've not spoken about is the use of non-financial technical assistance as well, being able to be used and acknowledged as blended capital. And so there's a deal that we did again from this Impact First concessional fund, which was supporting an Indigenous-led organization that was supporting Indigenous businesses. And so going back to Catherine made the point about Grok, and the reason that they were happy or able to take this risk is that they had a deep understanding of their market, of their clients. That for us was very much the same as First Australians Capital, who had been a service provider supporting Indigenous businesses, very close connections to the community, and had identified these gaps around the need for additional capital, but there wasn't the supply there. And so we supported First Australians Capital with, again, a blend of a repayable finance, so money effectively for on lending, some grant capital for use of for OPEX, initial OPEX, so that they could hire more staff with capability to be able to assist, and then also non-financial technical assistance, so taking investment committee seats, sharing all of our resources with them to try and help them along that journey. So on that Impact First Fund side, this is very much about how can we use blended capital to be able to catalyze, to support something which was reasonably new, to enable the impact. So that was the primary concern and consideration. But then on the 10% carve out that we have from our endowment, so that's what we call our endowment impact fund. Again, there very much what we think about is being catalytic with the way in which we use our capital, but it's not necessarily about concessional returns. And so whenever you look at the definition of catalytic capital, yes, it can speak about concessional returns, but at the same time, it can also talk about accepting disproportionate risk. And so that's absolutely kind of what we think about. So there, the use of our blended finance, typically from Vito's model, we would tend to be at the top of that stack. So looking for the senior position and some form of capital protection. Really to kind of, yes, deliver that and create that impact, but also to have a more solid return to enable our financial target. There's a transaction that I can point to, which is a a women-led bond, which operates out of Singapore, supporting women-led organizations in emerging economies. And they effectively have that model which Vito pointed to in his graph, by which they have his chart, sorry, by which they have a guarantee layer, they have a subordinated layer, and then they have a senior layer as well. And so that's a transaction that we've kind of been party to as well, but that on the senior side. So really, I think what I'm trying to get to is that the objective of the blend and what you're looking for can very much vary based on, and as can your due diligence and the focus areas based on where you're looking. And so for Ramsey Foundation, we're fortunate to be able to operate across that spectrum of capital and therefore be able to receive or be part of different types of blended deals.
Vito, I'm conscious we're talking here about a range of deal sizes. You know, Ben's talked about a $5 million deal with Australian Spatial Analytics. Catherine's talked about, you know, hundreds of millions of dollars going into wind farms, I think was an example Catherine shared. But from your perspective, in terms of deal structuring, Vito, is there much difference between a $5 million blended finance deal and a $1 billion blended finance deal?
I mean, the flat out answer to that is absolutely not. There is literally no difference in structuring a $5 million deal. I was listening to Ben explain the deal that he structured where he was in different parts of the capital stack, and he was talking about $5 million and he split it in two, and he was in the complexity behind what he's just explained and the other roles of the other people in that capital stack who need to understand what drives Ben and why Ben wants to be in this part versus that part. And whoever's leading that deal has to structure backwards to make sure they could bring Ben where he wants to be, and the government where they want to be, and the commercial investor where they want to be, and then take all those impact stacks and the capital stack and put it together and negotiate it. There's a reason why these things last 2 years or a year and a half to put together, because of the inherent complexity behind it. And that's the difficulty in these things. And you talk about a $1 billion deal, CDPQ being a $450 billion pension plan. We don't do deals on average under 100 to $300 million. The big one that we did in developed markets was an $8.5 billion deal, which we did here on the island of Montreal, which I think when you look at it on its face, looks like a pure project finance transaction between the provincial government, the federal government, and CDPQ to build an electric light rail system. But when you open the hood, you realize this is pure blended finance at its best. And why? Because the solved problem that was being solved here, and it could be solved for 5 million, as in this case, it was being solved for 9 billion, was the actual party who wanted the product. And in this case, it was a 26 station, 56 kilometer light rail system that would connect the metro system, the train system with the entire island of Montreal. They didn't have $9 billion to put out of their pocket to build it from scratch without hurting their credit rating. And that's the solution that we created for the province as an institutional investor that basically designed, constructed, and is now operating this system with a 99-year concession with the ability to renew it for 99 years. And the way we did that was we were the senior equity holder with a senior return. We have the province of Quebec that takes a return relative to their bonds on the market, which is below what an equity investor would take generally. But this way they would be able to have an asset on one side of the balance sheet and a liability, which allowed itself to even out, not affecting their credit rating. And we brought in the Canada Infrastructure Bank, which is the federal government, at very long-term loans at extremely low rates that are not market rate, which allowed the entire system to work, and worked with all of the constituent parties. Now, I'm not going to say that $9 billion across 26 stations may not be as complex as a $5 million deal. This had certain complexities because it had all the municipalities across the province, and that certainly comes with large infrastructure, but the process at its core is exactly the same. The only difference is that you enlarge the various people that are around the negotiating table, or you tighten them down. Rather than being 150, you have 4 or 5. But in the end, you're always negotiating the same thing, which is how do we give everything what they want while all these people are putting something in. So everyone takes something out and everybody puts something in, but it's not always the same thing. And that's the super interesting part about blended finance and the puzzle, I think, that it creates. And what we see is that these models, I mean, I explained it to you for a light rail system, but we've used it in emerging markets. We did a $5 billion pan emerging market transaction with Brookfield and Altera, which was right after COP28, I believe. And that brought the largest investors in the world to do private equity for transition financing pan-EM. First of its kind, fastest to market, 6 months from idea to close. $1 billion subordinated capital tranche with $4 billion of senior. Extremely innovative, very effective. If I show you the stack, it's the most simplified version of what I just showed in the example. Very simple, 2 pieces, that's it, to solve a specific problem at speed. And then there's other models that get way more complex when you start going into the frontier markets and start solving for more difficult problems. And I think that's one of the things that we need, sort of people on the call need to understand, is it can get complex, because the more complex the problem you're trying to solve, the more complex the solution. I think what's important from an investor perspective, and this is hard lessons learned personally, is start simple. Learn how to do this. Solve simple problems at the beginning, and then you get to see the power of the capital that's in the market, and it builds on itself. And you're no longer having conversations internally about, what is blended finance? Does it work? So once you've done it, nobody asks you what concessional capital is anymore. They just say, okay, that's the capital stack. And I think that's important. Is you need to crawl before you walk and walk before you run. And blended finance is no different.
And we've heard a couple of examples already about deals that involve multiple investors in the stack at different points. How easy is it to balance diverse investor and investee objectives, expectations, ways of working?
Difficult, I think. And I think so obviously at the moment we've spoken a lot about the expectations that different investors want, but actually there's the flip of that is that each of these different investors can bring different experience and skill sets. So actually you can kind of mold and meld all of these different expertise together to create something fantastic. It is also, though, very easy to be able to have misalignment of objectives. And I think the other thing which really resonates is Vito spoke about effectively the amount of time that this takes, the amount of heavy lifting, and that absolutely kind of resonates with us. And I also think there's a power imbalance as well. So I think different investors, again, will have slightly different motivations, but effectively the thing that everyone needs to understand is that the deal falls apart unless everyone's kind of playing their part. And so actually trying to come in and kind of occupy most of the power doesn't really work as well. And that doesn't even include then the investees. So if I can just bring one more example forward of a blended transaction that's recently closed for us. So in the Northern Territory in Australia, we've been just kind of finalized a deal which is looking at Australia's first First Nations owned community solar project. That has been at least kind of 18 months in the works, because it's again, on paper it should be relatively simple. You've got government that have come in with effectively a grant layer. We're coming in on a concessional subordinated layer, and then we've got a senior lender there. And in total, the deal's about $20 million. But it's not just been a case of how do you get these different actors to work with one another. But then on top of that, obviously we've got things like power purchase agreements, we've got construction, we've got land lease agreements, all the rest of it. And so this has just taken a huge amount of time. But then on top of that as well, obviously what we can't forget in all of this is the purpose. Why is it we're doing this? And in this particular instance, it's all about community ownership. And so we've got to ensure that the investees have also got a seat at the table. So for us, that's kind of completely kind of absolutely fundamental in this deal. If we're looking at kind of community ownership with renewable energy, that has to be there as well. And so then there's an additional component. So everyone has obviously got different expertise, different capability as well. But I think again, you can kind of flip that on the beauty of how a transaction like this could work is that everyone does have slightly different expertise and experience, and you do have an ability to kind of create efficiencies. So with a senior lender, for example, so they had far more experience than we did in the renewable space. And so we were able to lean on them. But then on top of that, we were able to share some of the external due diligence costs and some of the resourcing as well. So there were efficiencies that which be created there. But I think, fundamental, not just in blended finance, but I mean, really in life, it's about you've got to be able to build and maintain that trust and act with transparency and integrity. Without that, the transaction, I think, becomes infinitely more complicated.
Thanks, Ben. So I'm going to come back to Catherine now, but just before I do, just a prompt for those on the call. We're going to have questions shortly. Thank you, Murray, who's just put a question in the chat. But if any other participants would like to put a question in the chat, now is probably the time to start thinking about it, or raise your hand and we'll come to you. Just before that, though, Catherine, at the outset, we talked about where Australia is, and you flagged that you had some ideas for kind of future actions and recommendations that would help stimulate blended finance investing in Australia. Can you talk through some of the things that are being discussed and considered?
Well, probably the biggest one, I think, would be, and I think Vito's alluded to it, with the size of investment that they're really looking for in a pension fund, which the same applies for the super funds here. So in that conversation, they talked about, people coming with a community energy battery project for $1 million, or some incredibly demonstrated high-risky clean tech project, or all these sort of high risk and small projects. And it wasn't that they don't want to be part of the climate transition and they don't want to invest. This is not how they invest. So I think the other part of all of this is understanding all the different capital sources and what they actually need, as the others have both said. So the idea we had after the roundtable, which I'm now sort of exploring with a working group, is blended finance, and it's for climate, but I guess in some ways it could be for other purposes, but an aggregator fund, which actually would be very much more efficient and would gather projects together and scale opportunities to a size which in Australia they were pretty much saying at least 50 million for a fund to be investable by super funds. So, and to make it very efficient, use standard documents, preferably use an existing fund manager that we already have set up here. There's a few of those, the specialist investment vehicles, for example. So that I think is very exciting, because that is a big weak point, and we could actually accelerate a lot of finance if we could set that up correctly. And I mean, Vito has experience with the Gaia Fund, which is a very big fund, and just recently with the Hamburg Sustainability Fund, which is now called Scaled. So he's seen how this can happen, and so he's inspired me to think we can do something here. The other thing I think is really that comes through from the super funds is Your Future, Your Super APRA annual performance requirements, and that means each asset class has to report against particular standards linked to, for say in equities, the ASX 300, but they have no lens of Paris Agreement alignment, no climate lens at all across them. They're not long-term horizons, so there's nothing that will sort of accelerate or encourage our climate transition. So people like ClimateWorks and Future Super are working on that and coming up with some sort of new policy ideas. So that's another area. And then I think the very first roundtable we had, I tried to be very careful that we had a few representatives from each source of finance. And the thing about that, which was just incredible, they were all going, "This is a great meeting. I've never met these people before. I'm always going to meetings where I know everybody." And that's really the guts of this, is that you actually can get to understand the other sources of finance. And then when an opportunity comes, you can start perhaps working together.
That's excellent. Thank you, Catherine, and thanks too to Ben and Vito.
Mm.